TheoTrade. This is Don Kaufman. It's December 13th, 2019, and you are watching the TheoTrade Weekend Update. All right, we're through it. Through what? We're through China. We're through the Fed we got to listen to. Brexit. It's all over with, people. You got to kind of ask the question, what's left at this point to really juice these markets? And before we actually get into any specifics, any charts, any trade ideas, let's talk about that for just a moment. So we just saw a tremendous amount of data, of information. I mean, listen, as a trader, this kind of week that we just passed through, this is not my thing. You don't like to wake up in the morning and, the bell goes off and 4 minutes after the cash open, boom, there's a tweet by the administration that rocks the markets higher or lower. A few minutes later, statements are retracted. I mean, it just went like that the entire trading week. And as a trader, again, I like to control my risk. I don't like to really leave things to chance. But if you look at this now, all right, it's all smooth sailing from here because, again, we have a trade deal. It's possibly on the table. I know now you're going to talk about phase 2 of the trade deal. We've actually got the Fed. The Fed's over and done with. Wait, I know you're going to talk about the repo markets. Yeah, we'll look at that in a moment. Then we'll talk about, of course, Brexit, but we don't know entirely what that's going to look like. Here's the point of all of it. Push it all aside. Stop listening to all the information, the tweets, the tweet-twastic kind of a week that we just passed through. Push it all aside. Here's one of the most important things. What you saw is a tremendous amount of these binary events that we just passed through. Great, as I said, push them aside, right? They're over and done with. Not so fast. If you look at the VIX and you follow the VIX contracted. It went down a little bit after we saw, the China deal kind of materialize. Maybe it went down a little bit on the Fed. It felt better after Brexit. But there's one big point that I think a lot of people are going to miss. And I'm really going to hammer you this on this weekend's video. And that's this. The SPX expected move. For the most part, that's the way the option market depicts risk. This week that we just passed through, right? The SPX expected move was sitting about $42. Then why this coming week, after we just passed through all of that, we passed through China, we passed through the Fed, we passed through Brexit, it's actually up next week. Now, I know as well as you do that there's some economic reports that come out next week. There's GDP, to push it all aside, because we just had a bunch of economic reports this week as well, and the Fed, and China, and Brexit. We are looking at an expansion of volatility for next week. In the near term, for some underlying reason, the markets, they're still fearful. And really, to get specific, if you look at the XLF, which is the financials, and those things were rocking in this past week of trade, their expected move, and again, that's how the option market depicts risk, right? The option market sees this coming week as more risk than we just passed through. And I got to think to myself, again, we were rocking this last week. I'm going to show you all of this right here, right now. Let's get to it. Couple of charts, couple of trade ideas.
To the charts and trades we go. Let's start with the big one. People, the SPX expected move, the mother of all products. By the way, once again, the SPX really rocking in terms of overall volume on a trading day. Got to recognize the SPX doing 1.85 million contracts in today's trading session. That's not bad considering the SPX finished the day massively unchanged. Pay very close attention to that because what we're seeing, and the reason I'm bringing it up, it's all about a concentration of liquidity. I'd bet pretty much about anything that the entire options marketplace only traded maybe 21, maybe 22 million contracts, of which almost 2 million of those are done right here in the SPX. You have to recognize, again, you throw a little spider in there. What are the spiders? I mean, the spiders, for the most part, are the same thing as the SPX. Throw the spiders in there, they're good for 4 million. Add those two up, what do you got? You got 6 million contracts right there, okay, that are all pushing around the entire marketplace. But I'll push that aside for right now. The point that I want to hammer home, again, inside of the SPX, number one, okay, expected move. Once again, we're inside of the expected move, okay, in this most recent trading week. Again, here's the week that we just passed through. Effectively, what did we have? Well, we had this past week about a $42 expected move. People, we saw every ounce of it. In fact, I even mentioned it in Wednesday night's video. I said in Wednesday night video, we had done nothing. I mean, the entire week was Monday, Tuesday, Wednesday, even after the Fed came out, it was a whole lot of nothing. All I said in the Wednesday night video, get ready to rock. And that's exactly what we did, eating up every ounce, again, of a $42 move. We got a hair shy of actually hitting the upper edge of the expected move in last week's trade. Now, time out for just a second. That now brings us, okay, to a grand total, all right, of 19 straight weeks inside of the expected move. 19 straight weeks inside the expected move. Now, if I draw this out kind of statistically for just a brief moment, so how often are you supposed to be inside of like one standard deviation, right? You're supposed to be in there about 68% of the time, except we've got 19 straight weeks in a row that we've effectively done this. Things, people, they are building. The situation is starting to come to a head. I mean, I'm thinking at 17 weeks, things were getting interesting. At 19 weeks, you can almost feel the tension. Now, for the most interesting part of this, okay, so we just passed through a week where we had this $42 expected move. And I think a lot of people look at the week and they think, wow, this was a blistering move to the upside. Was it really? I mean, take a look at the week at large for the most part. Well, we finished last week right here. Where are we? Right here. Okay, what does that amount to? Well, I'm actually going to take you directly into it. This happens to be last week's data. This is actually where we ended specifically, okay, the date. What was it? All right, we'll throw up the 6th. Why the 6th? Because that was last Friday. And on that Friday, right, we closed at 31.45 and change. Where'd we end up? 31.68 and change. What do you got? 24 point move? Which is a nothing move. It's a big nothing move. Now, for the most interesting part of this, last week with all of that data, right? We had the Fed, we had Brexit, we had the China deal. You had a $42 move. Again, about a $42.11 move. In fact, you can even see that right there. There's $42.11 we had down as last week's expected move. Except here's the little bit of scary part. If you actually look a week out, you're at $46 and change. So how could we pass through, okay, a week that was supposed to be chock full of nuts and end up with a higher expected move for next week? I mean, listen, this begs the question. I went over the calendar, right? I know GDP's coming out. Yeah, a little bit more retail sales, a couple more numbers dropping out there, okay? Personal income. I mean, I can go on and on. But it's not a China deal, okay? It's not the fact that Brexit's coming all over again. The marketplace right now just doesn't trust. Again, this marketplace, okay, just does not trust trade at this point. That's the only thing, okay, that I can actually come to and answer why the expected move is actually bid up. Now, we're going to look more at volatility in just a couple of moments, but I'm going to leave the SPX at that. I just want you to understand that the movement for next week is implied to be larger than the previous week of trade. Again, we have 19 weeks inside of an expected move. Why does that matter? Because we're getting to statistically, aberration. And the way that I positioned this last week, and I rather enjoy positioning things like this, the way that I positioned it last week is, again, if you looked at coin flips. Now, this is not a 50-50. Okay, it's supposed to be in there, 68% of the time. But if you looked at a coin flip and heads, we stayed inside the expected move, and tails, we moved outside of it, right? Except we've basically come up heads, and you're supposed to come up heads 70% of the time. But if you kept flipping that coin and flipping that coin and flipping that coin and flipping the coin, 19 times in a row now, we've actually effectively come up heads. The only difference is I don't look at the marketplace as independent coin flips. I look at the marketplace as having some degree of financial memory, which makes the fact that we're inside the expected move, okay, the anomaly. And the anomaly is what I would term efficiency. We are incredibly efficient right now. It's almost like the market is being internally controlled, okay, by a larger force. There is a larger force. It's called the SPX, doing 2 million contracts. Again, you may not respect the fact the SPX is doing 2 million contracts of an entire options market that's only doing about 20 or 22 million contracts, which is, there you go, it's 10% right there of the total volume. But this contract is 20 to 30 times larger than other contracts. What other contracts? Like Apple. Okay, what is Apple? Apple's a little peon. It almost did 1 million contracts. A little peon, though, compared to what? A $3,000 SPX. So what do you got? Okay, you got the SPX order flow jamming the market inside a very, very tight range. It's dangerous, people. That's the point that I'm trying to make. It's just dangerous. Let's move onward and upward. Bonds, okay? Are they making their move? The bonds for the last few months, okay, have actually just been winding up, okay, into a tighter and tighter, okay, kind of channel here. And net, and I just want to zoom into some of the more recent trade. Net, where have we gone lately? Absolutely nowhere. And more importantly than even looking at the chart on bonds, you know, you can look at TLT, whatever does it for you, right? We're forming the gigantic wedgie. But even more important, this impacts the interest rates. And the interest rates right now, okay, they came up to like 1.9%, backed off of it very, very quickly. The point that I am trying to make with bonds, people were ready to move. And I'm asking the question, is this the big one? Okay. My answer to that, and strictly my opinion, I do believe this is actually going to be a big move in bonds. And I believe that move is going to be to the upside. So all of this information is out. And you got to ask yourself, what's left to juice the markets, right? Not much. Okay. How much good news is out there? Now, if economic data starts to come out of this marketplace, you know, if it's not rosy economic data, what are they going to do? Can't blame it and point your finger at the trade deal anymore, because apparently that's over with. We're not really waiting on Brexit anymore, okay? Waiting to Brexit. So that should be over and done with here soon enough. And it's almost a certainty that Brexit is going to occur in some way, shape, or form, even if it's a little bit harder than we expected. So that risk is over and done with. The Fed said they're going to do absolutely nothing unless they need to do something, in which case they're going to do probably next to nothing. But the Fed is already doing something. I'll cover that here in just a moment. What do you got in bonds? Okay. I think you have capital that's probably going to flow into those bonds. Why? Market now is going to be left very, very nervous, very unstable. That's why I was saying last week that the recession fears are very likely to resurface. They kind of were, put aside in that last jobs number that we had 2 Fridays ago, right? Jobs number was hot, people. It was really hot. Yeah, but some other economics that have come out, maybe not so hot. Well, the bonds are going to start to pay attention. I believe they're going to rally. All right, is this the big one? How much are they going to rally? How fast are they going to rally? Okay, how low are rates going to go? I saw one estimate today that this little monkey right here, the TNX, could all the way be back by 1.2%. That was out from SocGen. I don't think they're far off. Okay, but you got to get somewhere first. Listen, if the rates start to get down to 1.6%, now this is new to some people, right? Looking at interest rates, but right there, okay, I know it says 16, but that is equivalent to the 10-year being 1.6, okay, percent. You get down to 1.6%, then they're going to be talking about the inversion to the yield curve. And I'm on this one already. Okay, I've seen this movie before, and I'm telling you, we come back down to 1.6%. Everybody gets nervous about the yield curve. They'll start talking about recession fears again. And then I'm going to have to listen to, of course, when people go, well, you know what? What's left to juice the markets? There's no more China. There's no more Fed. There's no more Brexit. It's going to be the election. Okay, we can't possibly go down in an election year. No, of course not. Did you ever look, though, at maybe, 2000? Maybe 2004, there was this election in 2008. You might have missed it because there was a crash going on during the time. 2012, there was actually, people thought we were actually headed back into the financial crisis at portions before that, only a few months before it. And it just, precipitates from there. And, 2016, that did not start off very well at all. And I can go on and on and on all about the election that you can't possibly let a market go down in that particular time frame. Not per se that I have a definitive opinion on that one, okay? But again, there's a lot of conjecture around that. So lower rates, the reason I'm bringing up lower rates, they're going to have a very definitive impact specifically on the financials. The financials, I have no qualms in saying this whatsoever. way higher than I've ever anticipated. We thought the financials were dead, stopped, done at 29.50. Here we are. We clipped to the 31 level. Just to actually display this, okay, a maximum chart. We are what? Okay, a hair off, effectively the all-time high. You're 1 penny. Again, missed it by effectively 1 penny off the all-time high. Gotta love that. So expect maybe a little bit of a burst of the financials to the upside. But hey, if you start believing in tops and bottoms over there, things got downright crazy inside of those financials. All right, I'll come back a little bit more to the financials because lower rates would actually pull those financials effectively down. And that's one of the big points that I want to kind of hammer home in this, all right? If interest rates, all right, so if rates, we'll fix that right up there in a second. If rates are going to go ahead and drop, okay, that's going to take the financials along with it. It's just a very simple arbitrage relationship over there. Then, of course, you could also consider the home builders in there as well. Why? Why even bother looking at the home builders? Well, the home builders, bring up XHB, okay? The home builders are also a kind of an interesting scenario. They're actually locked in a very, very tight range right now. In fact, I just want to highlight this. They're locked in a range. Why are they so locked up in this particular range? It has everything to do right now with interest rates. So if interest rates go up, that could actually hurt the home builders. But if interest rates are what? If interest rates are actually going down, it's very likely that the entire market at that point would be selling off, right? If the bonds continue to rally up, the marketplace would probably suffer because the financials would suffer. That too would possibly suck the XHB under. All right, it's kind of what I call like a little bit of a no way out trade in there. All right, onward and upward. So we talked a little bit about the SPX inside the expected move. It's just dangerous, right? The bonds, they're making their move. Very likely, I'm anticipating the move to actually be smoking to the upside. I've been looking for that now for the last 2 weeks. We've been talking about the possibility of the bonds. After all the trade negotiations are done, the bonds exploding back to the upside. Well, we're here. Next thing I want to bring up, repo. All right, listen, everybody's talking about it. Nobody even understands what they're talking about. For the most part, the repo market. Short-term funding. All right, I'm not going to get into too much detail on a weekend update about the repo market, but it's $500 billion they just said that they're going to commit. And I'm supposed to believe that there's not a problem. Don't worry. Jerome Powell told me that there was no problem. Yeah, I think I heard that from Ben Bernanke. I've definitely heard that before from Janet Yellen. And there wasn't much of a problem during Janet Yellen's reign. I definitely heard that from every other individual that's ever been at the Fed. There's absolutely no problem. But nobody's actually said there's never a problem, okay, with $500 billion in liquidity being pumped into the repo market to keep it alive. Just throwing that out there. Okay, hey, you use your own head in deciding if there's an issue in the repo market over there. By the way, the Fed also this past year lowered rates 3 times and is pumping capital into a seized market. Okay, excuse me for being the pessimist in the room. Enough. Okay, volatility backing off. So this is another aspect where a lot of people, they start to look at the VIX. The VIX did back off, but the VIX is the 30-day implied volatility. Totally makes sense the VIX backed off. Why? Because the holiday season is actually coming. So if risk, and this is where a lot of people are not necessarily aware of, if risk is coming like 30 days out, you wouldn't really feel it, okay? The risk would have to be like literally like inside of the next week, which is kind of what we're seeing. Some of the risk metrics picked up for this next week of trade. 30 days out, well, that's including, right? You know, Christmas week, it's including the New Year's week. So of course, okay, the VIX is going to collapse after this news kind of comes out. And some of the volatility futures backed off. But the vol future that backed off is the 5-day vol future. That's not the one you're supposed to look at. You're supposed to be looking at the 40-day volatility futures. Why? Because those are going to be a little bit more consistent. Those things are still trading up at the 15 level. They're down about 70 cents today. So vol, yeah, it did. It backed off a little bit today. But remember, in the near term, okay, in the SPX, that volatility is still extremely high. Last but not least on this front, the VVIX. The VVIX, okay, is out of the critical danger zone. I talked about this on Wednesday, how the VVIX, okay, when it gets above 110, it's Mr. Toad's wild ride. Right now, okay, it came off that 106 level. We're all the way back down to 96. I would say the 96 level is a highly guarded level. Okay, that's where I would feel like uncomfortable, but not like, oh, we're about to get our whole head ripped off, at one time. Just be aware of it. We are very, very guarded when it comes to future volatility. Next, to come to what's working and, well, what's not. So let's actually first start with a couple things that are working, specifically that I talk about, on almost a day-to-day basis. Each and every one of these I do carry positions in. So just to clarify and kind of quantify Costco, it's been working. It's been working pretty much the last month. It hit its earnings today. The stock dropped. I've actually rolled myself out. I've rolled myself out in time. There was a butterfly I used to hedge my position, but I've rolled half my position out to the February expiration for a massive credit today. It was like almost a $19 credit on a roll. It's one of the better rolls that I've had in Costco in quite some time. We'll actually switch things up for a moment, cruise over to Boeing. So as we go to Boeing, what's working and what's not? Well, Boeing, once again, is absolutely working. Just this little downdraft here from like 375 down to the 340. I'm sorry, that has been enough to get me some great rolls. And again, I've still got a January option on it. Just wanted to display this, okay? People, that's what we call deep in the money. So I'll be selling those 390s, okay, and buying what? I can come out here and actually buy the 390s, buy the 385s. That roll will be done for credit early next week. So Boeing still working. And last but not least on this front, okay, what's also working right now? Well, this is the first time in a long time, but Lulu. Okay, we're actually setting up for a roll inside of Lululemon, backed off big after its earnings, caught a little bit of a bid today, but still ended up down. We're going to look for some more sell side activity to hit Lulu. All right, what's not working? Anything remotely related to financials. You know what, though? I have to say, in financials, if you're in a position, okay, I apologize. If you're not in a position, people always ask me, like, is this a good time to enter? I think this is a pretty good time to enter. All right, I think you have the risk reward in your favor. Okay, I don't look at this as the greatest defeat. I'm going to look at this as possibly the greatest victory in terms of risk reward in there. Last but not least, a little stock chop. Let's go to Baba. A couple of stocks that I've been watching. Okay, Baba. I've now initiated a short position inside of Baba. Listen, this is not about the chart. It's all about the position. You've got to watch the in-out spread video that we're doing every single week now for all of you that are TheoTrade members. We are now doing update videos. We are doing update videos to give you an update on every single trade that I happen to be creating through time. But if you look at Baba, I'm in a bearish position in here. As I said, it's not about the chart. It's about the structure of the position. Okay, Caterpillar. Let's actually cruise onward and upward and over to Cat. Okay, Caterpillar also constructing another bearish position in here. We had a bearish position here a few weeks ago. That was it. Downdraft closed profitably. We're doing it again. Caterpillar, last but not least on the list. Okay, this one's actually going to be a bit of a bullish position. Tesla. Okay, at this point in time inside of Tesla, we'll actually open up a 3-year to see it. We believe it's going to crack into an all-time high territory. If you're short, watch out. Okay, this very well is likely the first portion of a leg that could take us drastically higher inside of Tesla. Nevertheless, open up a little bit of a broader chart in there. You can see a line drawn across the screen. That was a very long time ago. It was about the 390 level. All right, maybe the third or fourth time's the charm, but I would assume that Tesla is about to start to breach, maybe even to year end, into all-time high territory. I want to thank everybody for joining us here on this weekend's update. Again, keep your head in the game. You may think the holidays are upon us. You may think it's all over and done with. It's not. You're thinking there's nothing left to juice the markets. There absolutely is, people. Volatility still very much with us. Have a wonderful weekend. Bye-bye.